What's up, everybody? Well, we've got some breaking news. For the first time since 2012, home prices are down annually. Up until now, even though the housing market has been correcting for the last 6 to 8 months, home prices were still up year over year, even if only a little. Until now. This is big news. In Redfin's latest housing market update, they report that the median U.S. home sale price declined 0.6% year over year in February, marking the first annual drop since 2012. Unfortunately, that doesn't necessarily mean that homes are now affordable. We've seen in recent weeks that mortgage rates have really started to climb again. The daily average was 7.1% on March 2nd, which immediately dampened home buying demand. And according to the latest research from the Federal Reserve Bank in Dallas, U.S. home prices could tumble 20% as the highest mortgage rates in 2 decades threaten to trigger a deep global housing slide. So today, we'll take a look at Redfin's latest housing market update and the Fed Reserve Bank of Dallas's latest research to see where they think our housing market is heading and just how bad they think it's going to get. So let's just dive right in. Dallas Fed economists warned in their latest research report that the U.S. and Germany are at risk of a severe home price correction due to a tighter than expected monetary policy. While house price growth has recently begun to moderate, or in some countries to decline, the risk of a deep global housing slide persists, wrote Dallas Fed economists. According to their analysis, the U.S. house price-to-income ratio in 2022 surpassed its peak level hit at the height of the 2000s housing bubble. But unlike in 2008, this time around, we are not suffering from a housing crash due to the subprime lending crisis, which then resulted in an abundance of foreclosures and short sales when homeowners simply could not afford to pay their mortgages once the payments increased. However, the Dallas Fed economists say that the U.S. home prices can still fall. In fact, they said in order for the U.S. housing market to return in line with its fundamentals, they estimated it would need to experience a 19.5% decline. This all stems from an affordability crisis. In most places after the pandemic boom, local incomes simply could not support the new inflated housing prices. This is the real problem. According to Redfin's latest housing market update, U.S. home sale prices have fallen from a year earlier for the first time in a decade. This milestone comes as mortgage rates continue to climb, causing sellers to reduce their asking prices to accommodate the higher rate. Home prices skyrocketed so much over the last few years that they were likely to come down once rates rose from historic lows. Mortgage rates rising to the 7% range was the straw that broke the camel's back, dampening home buying demand and leading to sellers asking less for their home, said Redfin Deputy Chief Economist Taylor Marr. Redfin reports that the median home sale prices dropped in nearly half, 24 out of 50, of the most populous U.S. metros, with the biggest drops in the pandemic home buying hotspots and Northern California. Austin saw the biggest dip, down 11% year over year, followed by San Jose, California, down 10.9%, Oakland, California, down 10.4%, Sacramento, down 7.7%, and Phoenix, down 7.3%. That is the biggest sale drop on record for each of those metros, except for San Jose. Prices falling from a year ago is a milestone because it hasn't happened since the housing market was recovering from the 2008 subprime mortgage crisis. But it's not surprising, and in many ways, it's welcome, said Taylor Marr. But even with home prices falling year over year, home prices are still not necessarily affordable. According to Redfin, the typical monthly mortgage payment is at a record high of $2,520 due to the elevated mortgage rate. To put things into perspective, U.S. home prices measured by the seasonally adjusted Case-Shiller National Home Price Index have fallen 2.7% from their June 2022 peak through December of 2022. Back in the housing crash of 2008, U.S. home prices fell 26% peak to trough between 2007 and 2012. So while some of the more bubbly housing markets have seen a price decline, decline of up to 11% year over year. In general, on a national level, we have really seen only a modest home price correction. While a modest housing correction remains the baseline scenario, the risk that a tighter than expected monetary policy may trigger a more severe price correction in Germany and the US cannot be ignored, Dallas Fed economists wrote in their latest article. Noted. And honestly, if rates keep going up, in order for houses to become affordable, prices have to come down. But it's not as simple as that. We need more inventory. And like I've discussed in past videos, I honestly don't think builders have recovered yet from 2008. Add a pandemic, high lumber costs, and other essentials, even if builders start to build more, the prices are still unaffordable in most areas. And homeowners, or would-be sellers, well, they're not budging. They don't want to trade in their 3% or lower mortgage rate for a 6% or higher. It just doesn't make sense to them. Prices will probably decline a bit more in the coming months, but first-time buyers hoping to score a major deal this year are likely out of luck. Redfin's deputy chief economist, Taylor Marr, continued. That's because so few homeowners are listing their homes for sale. Limited inventory and continuing interest in turnkey homes in desirable neighborhoods will keep prices somewhat propped up, and high rates will continue to be a hit on affordability. But I honestly think that the next few months will tell us the story of the next few years. Something has got to give. And even if the Dallas Fed is correct, and we do experience a more severe housing price correction, it is still unlikely to match the housing crash of 2008 through 2012. But what do you guys think? What are you seeing where you live? Because as we know, real estate and housing is very localized. So what I'm experiencing here in the DC area is definitely different than other parts of the country. Comment below, tell us where you are, and tell us what you're seeing. Let's look at some more data from Redfin's housing market update that covers the 4-week period up to February 26th and see the trends moving forward. And like always, I'll give you my opinion as well. Pending home sales were down 15% year over year, the smallest decline since July. So this just confirms that activity is still down, but just not as bad as it has been for the previous 6 months. Pending home sales fell in all of the 50 most populous US metros. They fell most in Las Vegas, 55.2% year over year. Austin, down 49.5%. Portland, Oregon, down 46.9%. Riverside, California, down 45.4%. And Nashville, Tennessee, down 45.3%. New listings of homes for sale fell 20.3% year over year. New listings declined in all 50 of the most populous US metros, with the biggest declines in Oakland, California, down 45.1% year over year. Sacramento, down 42.6%. Seattle, down 42%. San Jose, California, down 41.6%. And Portland, Oregon, down 41.6%. Sellers, like I said, are just not putting their homes on the market. Active listings, which is the number of homes for sale at any given time during this 4-week period, were up 19.6% year over year, the smallest increase in more than 2 months. This just means that homes are taking longer to sell, not necessarily that new homes are coming on the market. Homes that sold were on the market for a median of 50 days. That's up from 31 days a year earlier, and the record low of 18 days set in May. I think that one's self-explanatory. On average, 4.9% of homes for sale each week had a price drop, up from 1.9% a year earlier. So this is still increasing every month. So it sounds like sellers are getting a little more realistic about their prices, because 4.9% still isn't a huge number, but they're still putting it on too high and having to reduce. Months of supply, a measure of the balance between supply and demand, was 3.5 months, down from 4.4 months a month earlier, and up from 2.1 months a year earlier. So activity is up from a few months ago, but I honestly think that that's normal for this time of year. I hope you got some value out of today's video. video. It's a lot of work, but I think it's really important to give you the most up-to-date information on the housing market so you can make the best decisions for you and your family. If you did get some value and you want to show our channel some support, definitely smash that like button, comment below, and subscribe to our channel. It just helps us with the YouTube algorithm and motivates us to make more videos. And if you want to see other perspectives on the housing market, check out these two videos. They're all from different sources. Thanks for watching. I do appreciate it. Bye!